We have shown three ways to conceptualize the rate of return. None of them used the cash flows. Remember that the first way to conceptualize the rate of return of the project was to divide the total return by the total capital. The total return is the sum of the first income and the second income discounted by one period, and the third income discounted by 2 periods, and so on until the last income is discounted by n minus 1 periods. This is the total return, which is divided by the total capital, the capital invested at the beginning of the first period, the capital invested at the beginning of the second period, discounted by one period, and so on until the last capital, which is invested at time n minus 1. Note that we do not use cash flows. We use profits, incomes, returns, and capitals. The second way of conceptualizing a rate of return is to compute the weighted mean of the holding period rates. And so we have the rates of return for each period and the weight W of t, which is the present value of capital C of t minus 1 divided by the sum of all the present values of the capitals. In this second way, we do not use cash flows. We only use rates of return, holding period rates, and therefore incomes and capitals. Okay, holding period as we know, holding period rates are given by the profit, the income, divided by the beginning of period capital. So we do not use cash flows. Third way was just a variant of the first way, and it conceptualizes the rate of return as the ratio of the present value of all the incomes to the present value of all the capitals, and then convert it to an annual rate of return. In these three framings, we only use incomes and capitals. We now show a fourth method, a fourth way of conceptualizing the rate of return, which makes use of cash flows. So we do not need cash flows to compute a rate of return, because a rate of return is an amount of return per unit of invested capital. So we only need returns, and returns are incomes, profits, incomes and capitals. However, we can derive a rate of return from the cash flows if we want to use the cash flows. We now show a fourth way of conceptualizing the rate of return of a project, which makes use of cash flows. And this fourth way has to do with cash flows and with net present value. As we know, the net present value is the discounted value of the cash flows. Let F denote a cash flow. We discount the cash flow by the cost of capital R, then sum the present value of the cash flows and we get the net present value. Now in this video we link the AIRR to the NPV. More precisely, we start from the NPV, from the cash flows and from the NPV, and then derive the rate of return of a project. To this end, we consider again a two-period project. Two-period project with three dates: 0, 1 and 2. For example, 2 years. And if I remember well, the profits, the incomes were 375 at the end of the first year and 225 at the end of the second year. The invested capital at the beginning of each year were 600 and 400. Now, with these data, we are able to compute the cash flows. Just consider that in the first year, depreciation is 200. And in the second year, depreciation is 400. Consider that the capital at the end of the second period is 0. So we start from the income and add depreciation. So we write back the income 375 times 1, 225, and then we add depreciation. Depreciation essentially is the change in capital, so we can also write the change in capital with negative sign. At time 0 we have minus 600, which is the capital expenditure. At time 1 we have 200 depreciation. At time 2 we have 400 depreciation. And then we just have to sum and the cash flow. And the cash flow for each year is as follows: minus 600, 575 and 625. We have the cash flow. We have the cash flow for each date, so we can compute the NPV. NPV is minus 600 plus 575 discounted by 1 period at the cost of capital. Remember that the cost of capital were assumed to be 15%, so divided by 1.15, and the last cash flow is 625 divided by 1.15 raised to the second power. This is the NPV. Now the result is 372.6. Now, how can we get the rate of return of the project from the NPV? Now consider that 372.6 is an absolute measure of worth, and while the rate of return is a relative measure of worth. So the first step is to transform the absolute measure of worth in a relative measure of worth. To this end we can divide 372.6, the NPV, by the total capital invested. Now we remember that the total capital invested is 600 plus 400 divided by 1.15, and that this gives 947.8. We have computed the total capital in the previous videos. So we divide by 947.8. We get 0.3931. This is the NPV per unit of invested capital. This is a relative measure of worth. NPV per unit of invested capital. This is an instantaneous measure, because numerator and denominator refer to time zero. It's a bang for the buck measure. What we want an annual rate of return, so we have to multiply this measure by 1 plus the cost of capital to convert it to a period rate. This is 0.452. Essentially, this is 45.2%. Now, this is an excess return. This is an excess return rate. Excess return rate. This tells that investors earn 45.2% more than the 15% they might earn if they invested in the market. So this is a rate of return over and above the cost of capital. So the last step is as follows. We know that this is an excess return rate. So excess return rate means that this is the difference between the rate of return of the project and the cost of capital. 45.2%. Therefore, the rate of return of the project must be equal to 45.2% plus 15%. This makes 60.2%, which is exactly the rate of return we have found in the previous videos. In general, when we have an n-period project, we can compute the rate of return in the following way. We take the NPV and divide it by the total capital. We have used the symbol PV of C as the total capital, the sum of the present value of the capitals. Now this is a bang for the buck measure. This is an instantaneous excess rate of return. We convert it to an annual rate of return, or more generally to a period rate of return, by multiplying this ratio by 1 plus the cost of capital. And this is an excess rate of return. We can call it excess AIRR, and we just have to add the cost of capital. And what we have is the rate of return of the project, the AIRR, project rate of return. Now this relation is a rather significant one, because we can also reframe it in a different way. Consider that subtracting the project rate of return and the cost of capital, subtracting the cost of capital from the project rate of return and dividing by 1 plus the cost of capital, we have the NPV per unit of invested capital. And this means that we can write the NPV as a product of the total capital invested which multiplies the excess AIRR discounted by 1 period. In this way, we have that the NPV is expressed as a product of the investment scale, total capital investment, the investment scale or the investment size, and the economic efficiency of the project. The economic efficiency of the project. This economic efficiency is expressed times 0. So we see that the rate of return, along with the cost of capital, is a value driver for the NPV. The second value driver is the investment scale. The net present value, so the economic value created by a project, is the product of how much I invest, the investment scale, and how economically profitable is the project. Let's apply this formulation to our example. We have computed an NPV of 372.6 for our period projects, and the rate of return is 60.2%, while the cost of capital is 15%, and the total capital invested is 947.8, and we take 947.8, which is the investment scale, and multiplies it by the economic efficiency. Numerator is 60.2% minus 15% divided by 1 plus 15%. And making the computations, we indeed get back the NPV 372.6, which also means that we do not need the cash flows to compute the NPV. We just need the capital, total capital, and the rate of return derived from the incomes. This is the rate of return, or IRR, rate of return, and the cost of capital, which is the benchmark that investors must consider when investing.